Hello, Nasdaq followers, and welcome to another episode of Trade Talks. I'm your host, Leanne Alfaro. Joining me right now from the Market Intelligence Desk is Brian Joyce. Brian, thank you so much for joining us.
Thank you for having me.
So crude oil is having its worst day in 2019 so far. You wrote in today's mid-blog. Let's go ahead and take a look at the first chart here.
Sure. So certainly it's been a big risk-off day, but not just for oil, but for all the asset classes out there. In commodities, oil is certainly the best representation of that class. And what we see today is a nearly 6% decline in oil. With the weekly inventory data come out, which was sort of a bigger build than expected. I think they're actually looking for a decrease versus last week. So not only that, but I think the bigger concern is the U.S.-China trade war, and the potential hit that's going to have on demand going forward. So I think a large part of this is based on that. We see right here today's price action. Well, first yesterday it broke down below the 50-day moving average. Today it's breaking down below the 200-day moving average in violet and yellow. You can see right there. Those averages recently made a golden cross, which typically is traditionally a bullish signal, but in this case certainly did not play out that way. It briefly acted as support in late April, early May, but now we have the breakdown. Given the dramatic move higher, this is, believe it or not, a somewhat orderly pullback as far as we've only retraced not even 38.2% of the entire move since the December lows. So I suspect that we'll at least retest or test that 57.34 level. And if we have a bigger pullback, I could see it maybe moving into the mid-50s, around the 55 level, which would represent the 50% retracement of that uptrend from December up until the April high.
And we're covering all our four asset classes here. So next, let's take a look at the S&P and see what we're looking at there.
So the S&P 500, we're down about 1.7% today. Today's low is around 28.07. It's essentially retesting the low made last Monday at 28.01. So we still are trading above that level. I suspect that level is going to break. As we've noted numerous times before in the past, 28 to 28.16 is a key support. It represents the highs made in October, November, and December, as well again as in February and March. So clearly it's an important price level. It may take a little time, but I suspect the price is going to break down through that, given what we're seeing, given the widespread concerns in the marketplace. Just below it is at 27.76 is the 200-day. And down as far as 27.22 is the 38.2% retracement. The initial move down to last Monday was a 5% decline, about 153 points. If we have a similar move down from last week's high, that takes us to about 27.40. So there's a number of levels down there where you could see support: the 200, 27.40, and then the 38.2 retracement at 27.22.
And what about rates? Let's take a look at the 10-year yield curve here.
So this is the 10-year Treasury yield. As you can see, we're breaking down below 234, 235, which was the low made back in March. So this is, we haven't seen this low in a few years. We touched today at 2.29. So that's almost 100 bips below where we peaked last October at 3.26. So certainly a dramatic move lower, reflective, of course, of investors seeking a safe haven in Treasury bonds, which when bond prices go up, yields come down. So, and if we go to the next chart, this is, I think, one of the most noteworthy charts that we have here. What we're looking at is the yield curve today in yellow, and then looking at the yield curve the week before the last FOMC meeting in December when they raised interest rates, which in hindsight looks to have been a mistake. So back then in mid-December, the curve is sloped or shaped the way it should be. The further we go out in duration, the higher the rates are. Currently, in yellow, as you can see, what's going on now is that we have a curve inversion. From the 1 year through the 10-year, it's not only trading below the 6-month Treasury yield, but what it's also trading below, which I've highlighted in violet in the horizontal dashed line, is the Fed funds rate, the overnight rate. So virtually everything west, or let's say to the left of the 30-year Treasury yield, is trading below the overnight Fed funds rate. So that tells you right there that the market thinks the overnight rate is too high. Investors are reaching for yield, and so accordingly, their net market is now pricing in an 81% chance that the Fed is going to cut rates by the December meeting. That's the highest probability we've seen this year. So, and I suspect that could even go higher.
And last but not least, let's take a look at the dollar here.
So this is very important because the dollar is so instrumental in global trade. We could see today it made a brief new high, the highest level since roughly mid-2017, and then made a sharp reversal lower. The majority of this basket is made up of the euro dollar, the euro versus the dollar. It's about 58% of this weighting. And accordingly, that made a new low today and then reversed to the upside. What's important about the euro dollar is that it recently made the width of the weekly Bollinger Bands recently made a 40-year low, which reflects very tight trading ranges, what we would call coiling price action. And when that reverses, which could right now be in the early stages of doing, a lot of times you'll see very explosive type of price action. There's also a big short on the dollar versus the euro. It's at a 3-year high. The non-commercial traders, which you could see in the Commitment of Traders report, which comes out each week. Last time it was at this level, the amount of shorts was in late 2016, and then we saw what happened in 2017 when that unwound. The euro had a 14% gain, which was a 13-year high. So we certainly have the recipe to see a similar type of move right here. So we'll have to wait and see how this unfolds. But why would the dollar be weakening? Considering it's traditionally seen as a safe haven, well, it could be because markets are really beginning to price in a rate cut sometime this year, and maybe multiple rate cuts going on to the middle of next year. So that would be a reason why maybe you would be bearish on the dollar here.
Definitely something to keep an eye on here. Brian, thank you so much for joining us and giving us your insight today.
I appreciate it.
All right, I'll see you soon back here on Trade Talks. Nasdaq followers, stay tuned for more coverage coming to you right here from the Trade Talks account.